Tom Lee is sounding the alarm on a potential stock market correction, but he is also making a very bullish prediction for what happens next. The Fundstrat head of research and chief investment officer says a meaningful pullback of as much as 15% could be coming, but he believes stocks could explode higher afterward and finish the year much stronger. In this video, I'll show you Tom Lee's interview on CNBC, then I'll break down exactly what he said and share my own thoughts on whether investors should be worried or preparing for a major buying opportunity. And finally, I'll reveal 3 tech stocks that could be worth buying right now if Tom Lee's bullish outlook plays out. Let's hear what Tom Lee has to say.
Yeah, and I can see the conditions because inflation, I think the risks are diminishing with today's jobs report, but also oil lower. So that means the bond market, which has been hawkish and leaning hawkish, could actually lean dovish. That's a tailwind into year end.
You agree?
Yeah, I think that's right. So I think Fed fund expectations are too high. They're coming down. That's broadening things out. If you look at the banks, they got through the stress test quite well. They're starting to pay out dividends, buybacks, so on and so forth.
Yeah, immediately, right? The news came out and they were like, okay, here's this for you and that for you and that for you.
And let's go, right? And so what we're also talking about is M&A. M&A activity is going to start picking up. That's going to help out the broadening. So I think it's all fair. You know, what we're looking at is housing stocks, which have been beleaguered for a long time. And we're also looking at gold in the material space, which will do well as that hawkishness comes off the table.
You know, you never want to be trying to catch a falling knife, but to me, I'm going to probably guess that those pullbacks are buyable. I think that momentum still has a long-term history of working very well, and it's really central to a lot of quantitative systems, so I think it comes back. And then on the DRAM trade, I know people are trying to call the end of the cycle, but you know, what we still haven't decided is there a new cycle, because you know, robots and machines are going to be semiconductor and RAM intensive much more than people, so it might be a long cycle.
Well, I don't know that people like the professor, for example, are trying to call the end of the cycle as much as they're trying to call the end of the craziness, right? I mean, stocks going parabolic, that can only go on so long. There is that thing, it's the pause that refreshes, right? They say that for a reason.
It's true, but what they have to keep in mind is that multiples of stocks like Micron are still, you know, 8 times, or probably today
Micron's
7 times.
Probably like 10 times now. Well, maybe with the pullback, it's
I think it's probably close to 7 times.
But it sort of got from like 8 to 10.
Yeah,
which is historically maybe rich for stocks like that are generally deemed to be more cyclical in nature. We're making the call, many are, that no, this is different. This is different this time. Now this is a secular new cycle, as you said.
Yeah, I mean, so NVIDIA's at 16 times. It reminds me of how Apple was viewed as a hardware phone stock for hardware maker for a long time. People thought it should trade at 10 times earnings until it re-rated towards 30. So to me, I think there's still that re-rating that's going to come with stocks like NVIDIA.
Speaking of earnings, you're going to get them soon, right? The banks are going to start. It's hard to believe they're already right here around the corner.
Right.
Good things are expected. Actually, that's a misstatement. Great things are expected.
Yep. So that's the one thing we're worried about. Rolling into 2Q, fantastic quarter, right? We roll into July, and everyone's telling me, seasonality, this is a great month. And when I hear that...
It is, because you haven't had a down July in a long time.
In a long time, but when I hear that, I get a little bit nervous. And I go back to 2007, and in 2007, in June, we had a down month. We had credit spreads less than 100 basis points. We had real rates rising. We had quants doing quite well. And let's just say the summer 2007, not so great.
Well, I mean, there was a little something going on there that, you know, had something to do with that.
Yeah, you had a lot more. You had a lot more leverage. You had credit spreads widening from very low levels.
Yeah, something called the housing market was starting to roll over.
The housing market might have had an issue there.
Yeah, speaking of understatements.
A little bit. But the point being is, just don't get comfortable here. Because you're right, fundamentals are quite good. Expectations are even higher in some cases. We think the market does go higher, but some choppiness, some pullback, some repricing of risk, it all makes sense.
But see, I ask you this every time, Tom, you're with me, because people, they hear you and they assume that you're always bullish, and directionally you are, with the caveat this time of you still are expecting a meaningful pullback in stocks at some point before another significant ramp up into the end of the year. And you haven't changed that, have you? And I ask you every time.
Yeah. And again, you know, I think we're still in this up phase. So I think near term, I think we can be 77, 7,800 first.
Okay.
And then a 10 to 15% pullback, but for understandable reasons. Because, you know, the Fed is something the market's trying to understand, and we've got an unlock of a major IPO coming. And There's cumulative shortages now in petroleum products that becomes a pricing risk later this year. But I do think the earnings momentum is very strong and investors are still off sides. And in fact, fund managers are having one of the worst years, actually in almost 5 years. This is one of the worst years for growth managers. And so I think they're going to buy that dip.
Are we vulnerable to something like that?
I think the pullback, I think Tom's right, but I think the pullback comes from a higher level, right? We're still looking at the fundamentals. We're still looking at credit. We're still looking at sentiment. And it's just not that far stretch. In certain areas, yes, and we're seeing that in semis, right? The semi pullback is pretty aggressive right now.
Yeah.
But the market's still doing quite well.
Is the Fed a risk?
I don't think so. I think people are overestimating the Fed. I don't think Kevin Warsh does anything. And if you listen to what he said yesterday, hey, prices are high, but inflation directionally is coming down in the direction we want it to. And if you look at where oil's going, break-evens, it's not telling you to be hawkish.
Yeah, I mean, we don't really think the Fed's going to hike.
I don't. But I think there's like going to be a communications tantrum, because the Fed is trying to move away from forward guidance and maybe not even having press conferences after FOMC meetings. And so the market's operating in a vacuum. They're going to try to sort of find implied pricing or predictions, and that's moving away from the Fed. So I think it creates volatility.
But didn't Warsh, the chair, respectfully, didn't he already sort of put his hand on unveil his hand? I mean, we know that the communication's already changing. What's going to surprise us now? If they get rid of forward guidance, we expect it. He alluded to it again this week in Portugal. So you get less Fed speak.
I think there's a chance that even Fed governors are asked to communicate less because each of those communications can be viewed as forward guidance.
Well, I don't disagree with you at all, but don't we know that?
I think until we get into a situation where we have no real comms and then there's inflation uncertainty or a macro risk that emerges and then we see that there's no Fed comms, that becomes kind of a potential crisis moment for markets.
No, we need to, get rid of the blankie every now and then, right?
I agree. I think we need to stop talking about the Fed put.
Yeah.
We need to let the markets trade, and this will be a good thing for active management and for the markets.
Stop talking about it as long as you know it's always there. Yeah. Gentlemen, good to see you. Have a good holiday weekend.
The first thing that really stood out to me was Tom Lee's view on inflation and interest rates. He believes the risks from inflation are actually starting to diminish. The latest jobs data and the recent decline in oil prices are giving the market reasons to think that inflation pressures could continue easing. Why does this matter so much? Because if inflation cools, the Federal Reserve has less reason to remain aggressive. The bond market has been leaning hawkish for quite some time. Investors have been pricing in the possibility that rates stay higher for longer. But according to Tom Lee, those expectations may be too high. If investors begin realizing that the Fed will eventually have to become more accommodative, that shift could become a major tailwind for stocks. Personally, I think this is one of the most important points in the entire interview. Markets move based on expectations, not just current conditions. If everyone is positioned for higher rates and those higher rates never materialize, then stocks could reprice significantly higher because investors suddenly have to adjust their assumptions. Tom Lee also pointed to the banking sector as another reason for optimism. The major banks recently passed their stress tests and immediately began announcing dividend increases and stock buyback programs. That's actually a pretty significant signal. Banks are among the most heavily regulated institutions in the financial system. If regulators are comfortable enough with their balance sheets to allow larger shareholder payouts, it suggests the financial system is in much better shape than many people feared. I think this is a point that often gets overlooked by retail investors. During periods of uncertainty, people tend to assume that something must be broken underneath the surface. But the strength being shown by the banking sector suggests that, at least for now, the financial system remains remarkably resilient. Tom Lee also believes merger and acquisition activity could start accelerating. Lower interest rates and better financing conditions often encourage companies to pursue acquisitions. Historically, increased M&A activity tends to be a positive signal because it reflects corporate confidence. Executives don't typically make billion-dollar acquisitions if they believe the economy is headed into a severe downturn. They make those moves when they see opportunities for growth. Another interesting part of the discussion involved housing stocks, gold, and materials companies. These sectors have lagged for quite some time, but Tom Lee believes they could perform well if the market becomes less worried about aggressive Fed policy. This is something I've been paying close attention to myself. For the past few years, almost all of the attention has been concentrated in artificial intelligence and mega-cap technology stocks. But bull markets tend to broaden over time. Leadership eventually rotates into other sectors. If rates start falling and economic growth remains stable, some of these forgotten areas of the market could suddenly become very attractive. The conversation then shifted towards semiconductors and memory chip companies like Micron. Some investors believe the semiconductor cycle is nearing an end because these stocks have gone nearly parabolic. But Tom Lee is making a different argument. He's asking whether we're actually entering an entirely new cycle. The rise of artificial intelligence, robotics, and automation could create a structural increase in demand for semiconductors and memory chips. Machines and AI systems require enormous amounts of computing power and data storage. In other words, this may not be a typical boom and bust semiconductor cycle. I think this is one of the most fascinating investment debates happening right now. Are we in another temporary technology bubble, or are we witnessing the early stages of a multi-decade technological transformation? History suggests that transformational technologies create winners that can outperform for years. Tom Lee even compares NVIDIA's current situation to Apple years ago. For a long time, investors viewed Apple as just another hardware company deserving of a low valuation multiple. Then the market realized that Apple had built an ecosystem and deserved a much higher valuation. Tom Lee believes something similar could happen with NVIDIA. Whether you agree or disagree, it is hard to ignore the fact that NVIDIA has become much more than a simple chip maker. It sits at the center of the artificial intelligence revolution. It has software, networking, developer tools, and an ecosystem that many competitors still struggle to replicate. Now, does that mean NVIDIA's stock can go up forever without corrections? Absolutely not. Even Tom Lee acknowledges that markets need pauses. Stocks cannot move vertically forever. Corrections are healthy. They allow valuations to reset, shake out speculation, and create opportunities for long-term investors. And this is where the interview became particularly interesting. Tom Lee remains bullish on stocks, but he also expects a meaningful pullback at some point. He believes the market could continue climbing toward higher levels first, potentially reaching new highs before eventually experiencing a correction of around 10 to 15%. I actually think this is a very balanced view. Too many investors make the mistake of becoming either permanently bullish or permanently bearish. The reality is that markets are messy. They move higher over time, but they rarely do so in a straight line. A double-digit correction within a long-term bull market is completely normal. In fact, some of the best buying opportunities in history have come during corrections that scared investors out of the market. The panel also brought up an important historical comparison to 2007. Back then, market conditions looked strong on the surface. Credit spreads were tight. Quantitative strategies were working. Investors were feeling confident. But underneath the surface, risks were building that eventually exploded during the financial crisis. The point wasn't that today's market is identical to 2007. The point was that investors should never become too comfortable. That is advice I completely agree with. Bull markets often create complacency. Investors begin believing that stocks only move in one direction and that every risk has disappeared. That is usually when markets become vulnerable to surprises. However, Tom Lee quickly pointed out that today's environment is fundamentally different from 2007 in several important ways. Corporate earnings remain strong, the banking system appears healthy, consumer spending has been resilient, and many professional fund managers have actually underperformed this year. That last point is especially important. If many institutional investors are underinvested or positioned too defensively, then any market correction could be met with aggressive buying as those managers try to catch up. In other words, the dip buyers may still have plenty of firepower. The discussion then shifted back to the Federal Reserve. Tom Lee doesn't believe the Fed is likely to raise interest rates again. In fact, he thinks investors may be overestimating how hawkish the Fed will ultimately be. Instead, he believes the bigger issue could be communication. The Federal Reserve has hinted that it may reduce its use of forward guidance and communicate less frequently with markets. That could create more volatility because investors have become accustomed to receiving constant signals from policymakers. This is actually a really important point. For more than a decade, investors have been conditioned to hang on every word from the Federal Reserve. Markets have become addicted to Fed communication. If the Fed suddenly steps back and allows markets to operate with less guidance, investors may have to learn how to price risk more independently again. Personally, I think that could ultimately be healthy. Markets should be driven by fundamentals, earnings growth, and business performance, not by every sentence spoken by central bankers. Of course, in the short term, less communication could create volatility and confusion. But over the long run, a market that relies less on the so-called Fed put may actually become stronger and more disciplined. When I step back and look at Tom Lee's entire message, it really comes down to three big ideas. First, inflation risks appear to be easing, which could create a friendlier environment for stocks. Second, corporate fundamentals and earnings remain surprisingly strong. And third, investors should prepare for volatility and pullbacks without assuming that those pullbacks automatically mean the bull market is over. That may actually be the biggest takeaway from this interview. The market doesn't need perfect conditions to keep moving higher. It simply needs conditions that are better than investors currently expect. And right now, Tom Lee believes expectations may still be too pessimistic in several important areas. Whether he's ultimately right or wrong, his message serves as a reminder that investing is rarely about predicting every twist and turn. It's about understanding the bigger picture, staying disciplined, and being ready when opportunities appear. Now let's dive in and talk about the three technology stocks that could become some of the biggest winners of the next decade as artificial intelligence, cybersecurity, and semiconductor infrastructure continue reshaping the global economy. Let's begin with the first stock on the list, Palo Alto Networks, ticker symbol PANW. Most investors think artificial intelligence is all about chips, robots, and chatbots, but there is another side of the AI revolution that doesn't get nearly enough attention: security. As artificial intelligence becomes more powerful, cyber threats are becoming more sophisticated, more automated, and much harder to detect. The rise of AI is not only creating opportunities, it is also creating entirely new risks. Every company in the world is becoming more digital. Every company is moving more data into the cloud. Every company is relying on software more than ever before. And every company is becoming a target. That's where Palo Alto Networks comes in. This company is one of the largest and most respected cybersecurity businesses on the planet. It provides firewalls, cloud security solutions, malware protection, threat intelligence, and AI-driven cybersecurity products to some of the world's largest organizations. The reason this business matters so much is simple. Cybersecurity is no longer optional. Companies can delay hiring, they can delay expansion projects, they can cut marketing budgets, but they cannot afford to ignore security. One major cyber attack can cost millions of dollars, destroy customer trust, and expose sensitive information. As digital threats continue increasing, cybersecurity spending has become a necessity rather than a luxury. That creates a powerful long-term tailwind for companies like Palo Alto Networks. One thing I really like about this company is that it has built an entire platform rather than a single product. Years ago, cybersecurity companies often specialized in one specific area. One company handled firewalls, another handled endpoint security, another handled cloud protection. Today, businesses want fewer vendors and more integrated platforms. They want one ecosystem that can identify threats, analyze vulnerabilities, and respond quickly. Palo Alto Networks has been positioning itself for exactly this shift. The company has spent years building a comprehensive security platform that combines network security, cloud security, threat intelligence, and AI capabilities into one integrated ecosystem. This gives the company a major competitive advantage. Once large enterprises adopt the platform, switching away becomes difficult and expensive. That creates high customer retention and recurring revenue opportunities. And that is exactly the kind of business model long-term investors should love. The company's strategic importance became even more obvious recently when analyst Shrenik Kothari of Robert W. Baird maintained a buy rating on the stock and kept a price target of $320 per share. The reason behind the bullish outlook is particularly interesting. Palo Alto Networks recently entered a partnership involving IBM and Red Hat's Project Lightwell. Now, at first glance, this may seem like just another partnership announcement, but it is actually much more important than that. This collaboration serves as a meaningful validation of Palo Alto Networks' virtual patching technology. What exactly does that mean? As cyber threats evolve, organizations need faster ways to identify vulnerabilities and secure their systems before attackers can exploit weaknesses. Palo Alto's technology helps automate that process. Its AI-driven tools accelerate vulnerability discovery and create more unified security workflows by connecting network security, threat intelligence, and exposure management. In other words, the company is positioning itself at the center of the next generation of cybersecurity. This partnership may not immediately generate massive revenue. Even analysts acknowledge that the near-term financial impact remains uncertain, but long-term investors should focus on something much more important: strategic positioning. The fact that major technology organizations are integrating Palo Alto's capabilities into broader security ecosystems suggests the company is becoming increasingly relevant in the future of cybersecurity. And in investing, relevance often translates into growth. Now let's talk about institutional investors. One statistic that really caught my attention is the number of hedge funds that own this stock. 87 hedge funds currently hold positions in Palo Alto Networks. That's a significant number. Hedge funds are not always right, of course, but when a large number of sophisticated investors are accumulating shares in a company, it is usually worth paying attention. These investors spend millions of dollars on research, industry experts, and financial analysis. The fact that so many professional investors continue to own Palo Alto Networks tells us that they see long-term value in this business. I think one of the biggest misconceptions about cybersecurity companies is that they are cyclical. In reality, cybersecurity spending tends to be remarkably resilient. During economic slowdowns, companies may reduce spending in other areas, but they cannot simply stop protecting their networks and data. In fact, periods of uncertainty can actually increase demand for security products. The world is becoming more connected every year. More devices, more applications, more cloud infrastructure, more artificial intelligence. And every new layer of technology creates additional security risks. That means the total addressable market for cybersecurity is likely to continue expanding for years. Another thing I find attractive about Palo Alto Networks is its ability to adapt. Technology changes rapidly. The companies that survive are the ones that evolve with changing customer needs. Palo Alto has consistently expanded beyond traditional firewall products and invested heavily in cloud security, artificial intelligence, and platform integration. That flexibility gives me confidence in the company's long-term prospects. Now let's talk valuation and future potential. Many technology investors focus only on companies directly involved in artificial intelligence infrastructure, but cybersecurity could become one of the biggest beneficiaries of the AI boom. Artificial intelligence is dramatically increasing the complexity of digital systems. As organizations deploy more AI applications, the attack surface grows larger. That means cybersecurity companies could become even more essential in the coming years. I personally believe cybersecurity may become one of the most underappreciated investment themes of this decade. Think about it. Artificial intelligence cannot reach its full potential unless organizations trust the systems they are using. Trust requires security. Security requires innovation, and companies like Palo Alto Networks are helping make that possible. Another reason I think investors should pay attention to this stock is its durable competitive position. Technology leaders often benefit from network effects and scale advantages. Palo Alto has spent years building relationships with major enterprises and government organizations. These customers typically sign long-term contracts and deeply integrate security solutions into their operations. Once those relationships are established, replacing the platform becomes difficult. That creates a business with strong customer retention and recurring revenue characteristics. Those are the kinds of businesses that often compound shareholder wealth over very long periods. Of course, no investment is without risk. Competition in cybersecurity remains intense. Innovation moves quickly, new threats emerge constantly, and expectations for technology companies can sometimes become very high. Investors should always keep those risks in mind. But when I look at the bigger picture, I see a company operating in one of the fastest-growing industries in the world, benefiting from powerful secular trends, building strategic partnerships, and continuously expanding its platform. That combination is incredibly compelling. The digital economy is only getting larger. Artificial intelligence is only becoming more important, and cybersecurity is only becoming more essential. If those trends continue, Palo Alto Networks could remain one of the biggest beneficiaries for years to come. And that is exactly why this stock deserves a place on the list of technology companies to buy now. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on the list is Marvell Technology, ticker symbol MRVL. When most people think about artificial intelligence, they immediately think about chatbots, image generators, or the companies making headlines every single day. But behind every AI model and every massive data center sits an enormous amount of infrastructure that has to process, move, and store unimaginable amounts of data. And that's exactly where Marvell Technology comes into the picture. Marvell is not a consumer technology company. It does not sell smartphones. It does not build social media platforms. And it does not get nearly as much attention as many of the larger technology names. Instead, Marvell operates behind the scenes, building some of the most important semiconductor solutions that make the modern digital economy possible. The company develops custom silicon, optical connectivity solutions, data center switching products, cloud networking equipment, storage technologies, Ethernet solutions, and security products. In simple terms, Marvell helps move the world's data. And in the age of artificial intelligence, moving data quickly and efficiently has become one of the most important technological challenges in existence. Think about what happens every time an AI model processes a request. Enormous amounts of information travel through servers, networking equipment, memory systems, and specialized chips. Every step in that process requires advanced infrastructure. Without companies like Marvell, artificial intelligence simply cannot scale. This is why I think investors sometimes underestimate this business. Everybody gets excited about the companies creating AI applications, but the infrastructure companies that make AI possible may end up being some of the biggest winners of all, and Wall Street is starting to recognize that. Recently, Cantor Fitzgerald analyst C.J. Muse raised his price target on Marvell Technology to $300 per share from $220 while maintaining a neutral rating. That is a massive increase in expectations. Why? Because the AI infrastructure build-out is increasingly being viewed as a generational semiconductor cycle. That phrase is extremely important. A generational cycle does not last for 1 or 2 years. It can last for many years and completely reshape entire industries. According to industry projections, semiconductor industry revenue could approach $3 trillion by calendar year 2029 and potentially exceed $3.5 trillion by 2030. Think about how incredible that number really is. The semiconductor industry is already enormous. For experts to believe that it can expand to that level over the next several years suggests that we are still in the early innings of a much larger transformation. Artificial intelligence is not a temporary trend. It is becoming a foundational technology that will touch almost every industry on Earth: healthcare, finance, manufacturing, transportation, education, defense. Virtually every major sector will rely more heavily on computing power in the future, and all of that requires semiconductors. What makes Marvell particularly interesting is that it focuses on areas of the semiconductor market that are experiencing explosive demand. Custom silicon and data center connectivity have become critical components of modern AI infrastructure. As companies build larger and more sophisticated AI systems, they need faster communication between chips and servers. Bottlenecks in data movement can significantly reduce performance. That is why networking and connectivity solutions are becoming increasingly valuable. And this is where Marvell has built a strong competitive position. The company has spent years developing expertise in high-speed data infrastructure solutions. As AI workloads become larger and more complex, that expertise could become even more valuable. Another bullish development came from Stifel, which raised its price target on Marvell to $350 per share while maintaining a buy rating. The firm's thesis was based on a very interesting observation. Several companies involved in data infrastructure and connectivity have recently reported better than expected earnings and raised guidance. Marvell was among those companies delivering strong results. This matters because it provides evidence that demand for AI infrastructure remains extremely robust. For a while, investors worried that spending on artificial intelligence could slow down after the initial excitement faded, but the numbers are suggesting something very different. Demand continues to accelerate, data center spending continues to increase, and companies continue to invest aggressively in AI infrastructure. Personally, I think one of the biggest mistakes investors can make is assuming that every technology boom follows the same pattern. Many people are still trying to compare the AI revolution to previous technology cycles. But artificial intelligence may end up being far larger and more transformative than many investors currently appreciate. Every major technological shift requires infrastructure investment. The internet required fiber networks, cloud computing required data centers, smartphones required mobile infrastructure, artificial intelligence requires massive semiconductor investment. And companies providing that infrastructure may enjoy years of sustained growth. One thing I particularly like about Marvell is that it sits in several attractive markets simultaneously. The company has exposure to cloud computing, it has exposure to data centers, it has exposure to networking, and it has exposure to artificial intelligence. That diversification gives the business multiple avenues for growth. Another thing worth discussing is institutional ownership. 79 hedge funds currently hold positions in Marvell Technology. Again, hedge funds are not always correct, but professional investors are clearly paying close attention to this company. The reason is simple. The market opportunity is expanding rapidly. As AI infrastructure spending continues growing, companies with specialized expertise and strong customer relationships could capture enormous value. Now let's talk about something that investors often overlook. The semiconductor industry has historically been cyclical. Periods of strong demand are often followed by periods of oversupply and weakness. That history makes some investors hesitant to buy semiconductor stocks after large rallies, and that concern is understandable. But the question investors need to ask themselves is this: what if this cycle is different? What if artificial intelligence creates a sustained increase in demand that lasts far longer than previous cycles? That possibility is exactly why many analysts remain so bullish on infrastructure companies like Marvell. AI models are becoming larger, data centers are becoming more complex. The need for high-speed connectivity is increasing, and demand for custom silicon solutions continues to rise. Those trends could persist for many years. I also think Marvell benefits from something that many investors underestimate: switching costs. Large technology customers do not casually replace critical infrastructure suppliers. Reliability matters, performance matters, long-standing relationships matter. Once a company proves its capabilities and becomes integrated into customer systems, those relationships can become incredibly valuable. That creates a competitive moat that is often difficult for new entrants to challenge. Of course, there are risks. Technology spending can slow during economic downturns. Competition remains intense, and expectations surrounding AI have become extremely high. Any sign of slowing demand could create volatility in the stock. But when I step back and look at the bigger picture, I see a company operating at the center of one of the most important technological transformations in decades. Artificial intelligence requires infrastructure. Infrastructure requires semiconductors. And Marvell is helping build the backbone of the AI economy. That is why this stock deserves serious attention from long-term investors. The next decade may be defined by artificial intelligence, and the companies supplying the picks and shovels for this technological gold rush could end up generating enormous value for shareholders. Marvell Technology is positioning itself to be one of those companies. And for investors willing to think long-term, that could make this stock one of the most compelling opportunities in the semiconductor space today. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third and final stock on the list might be the most overlooked company of them all, Applied Materials, ticker symbol AMAT. When investors talk about AI, most of the conversation centers around software companies, chip designers, and cloud computing giants. But there is an entire layer of the technology ecosystem that almost nobody talks about. The companies that build the machines used to manufacture advanced semiconductors. Without those machines, there are no advanced chips. Without advanced chips, there is no artificial intelligence revolution. And one of the biggest players in this critical industry is Applied Materials. The company provides materials engineering solutions, equipment, software, and services that help semiconductor manufacturers build the world's most advanced chips. In simple terms, Applied Materials sells the tools that make modern semiconductors possible. This business model is incredibly attractive because it places the company at the center of the entire semiconductor ecosystem. It does not depend on the success of just one chip design. It benefits from the growth of the entire industry. Whether companies are building processors for AI applications, memory chips for data centers, or advanced packaging solutions for next-generation computing, they all need highly specialized manufacturing equipment. That is where Applied Materials comes in. And right now, the company appears to be entering one of the most attractive periods in its history. Recently, B. Riley raised its price target on Applied Materials to $790 per share from $550 while maintaining a buy rating on the stock. That is a substantial increase. The reason behind this optimism comes down to two major areas: DRAM and advanced packaging. Now, those terms might sound highly technical, but they are actually very important to understanding where artificial intelligence is headed. As AI models become more sophisticated, they require significantly more memory and much more advanced ways of packaging chips together to maximize performance. The future of computing is no longer simply about making chips smaller. It is increasingly about finding ways to improve performance through advanced packaging technologies and more efficient memory systems. And Applied Materials has positioned itself right at the center of these trends. Analysts now believe that the company's long-term opportunities in DRAM and advanced packaging are much larger than previously expected. That is a huge statement, because when Wall Street begins revising upward its estimates for a company's long-term market opportunity, it often leads to a reassessment of what that business could ultimately be worth. The company is also benefiting from another important trend: increasing process intensity. As semiconductors become more advanced, manufacturing them becomes significantly more complex. That means semiconductor companies need more equipment, more process steps, and more sophisticated tools to produce each generation of chips. This complexity works in favor of Applied Materials. In many ways, the company benefits from the growing difficulty of manufacturing semiconductors. The more advanced the chips become, the more valuable the company's expertise and equipment become. I think this is one of the reasons why Applied Materials deserves far more attention from long-term investors. This is not a company relying on one temporary trend. It is benefiting from structural changes that could persist for many years. Another bullish development came from Jefferies, which raised its price target on the stock to $770 from $510 while maintaining a buy rating. The firm's analysts believe that DRAM and advanced packaging will outgrow the broader wafer fabrication equipment industry, largely because of artificial intelligence. That is an incredibly important point. Artificial intelligence is changing the economics of the semiconductor industry. It is creating entirely new demand for memory and advanced chip packaging technologies. And Applied Materials has meaningful exposure to both. The firm also believes the company is well positioned because of its exposure to leading-edge foundries and DRAM. That means Applied Materials is participating in some of the fastest-growing and most strategically important areas of semiconductor manufacturing. Now let's talk about institutional investors. 138 hedge funds currently hold positions in Applied Materials. That is by far the highest number among the three companies we've discussed in this video. Again, hedge fund ownership is never a guarantee of future performance, but it does suggest that professional investors recognize the strategic importance of this business. And frankly, I can understand why. Applied Materials is not just another technology company, it is an essential infrastructure provider. If the semiconductor industry continues growing for the next decade, companies like Applied Materials will likely remain at the center of that expansion. I also think there is something incredibly powerful about this business model. Every major advancement in artificial intelligence eventually translates into greater demand for semiconductors. Greater demand for semiconductors eventually translates into greater investment in manufacturing capacity. And greater investment in manufacturing capacity creates demand for the equipment that Applied Materials provides. In other words, the company benefits from the entire industry's growth. That creates a very attractive long-term setup. Now, there are certainly risks. The semiconductor equipment industry can be cyclical, capital spending can fluctuate, economic slowdowns can cause chip manufacturers to delay investments, and geopolitical tensions can sometimes create uncertainty throughout the supply chain. Those risks are real. But long-term investing often requires looking beyond temporary fluctuations and focusing on the bigger picture. And the bigger picture here is extremely compelling. Artificial intelligence is increasing demand for computing power. Demand for computing power is increasing demand for semiconductors. Demand for semiconductors is increasing investment in manufacturing capabilities. And Applied Materials is one of the companies helping make all of that possible. I personally think many investors underestimate how long this investment cycle could last. We are still in the early stages of artificial intelligence adoption. Companies are still experimenting with AI applications. Governments are increasing investments. Data center operators continue expanding capacity, and entirely new use cases are emerging almost every year. All of this points towards sustained demand for advanced semiconductors. That could mean years of opportunity for companies supplying the tools and technologies that power chip manufacturing. And that is why Applied Materials may be one of the most important companies in the entire AI ecosystem. It is not the company that gets all the headlines. It is not the stock that trends on social media every day. But sometimes the best investments are the businesses quietly building the infrastructure that makes the future possible. So, when I look at the three companies we've discussed today, I see three very different ways to invest in some of the biggest technological trends shaping the global economy. Palo Alto Networks gives investors exposure to the rapidly growing cybersecurity industry and the increasing importance of digital trust. Marvell Technology offers exposure to the infrastructure and connectivity that make artificial intelligence possible. And Applied Materials provides exposure to the equipment and manufacturing technologies needed to build the next generation of semiconductors. All three businesses have strong competitive positions. All three operate in industries with powerful long-term tailwinds. And all three could potentially benefit from the continued growth of artificial intelligence and digital transformation over the next decade. Of course, no investment is guaranteed to succeed. Markets can be volatile, valuations can change, and even great companies can experience difficult periods. That is why it is always important to do your own research and make investment decisions that align with your personal financial goals and risk tolerance. But if you are looking for technology companies with durable business models, strong competitive advantages, and long-term growth potential, these three stocks deserve a closer look. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Which of these three companies do you believe has the biggest long-term advantage? Do you think cybersecurity, AI infrastructure, or semiconductor manufacturing equipment offers the best investment opportunity over the next decade? Let me know your thoughts in the comments below because I always enjoy hearing different perspectives from this community. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.